Good evening, everyone, and thank you for joining this deep dive discussion on one of the most fascinating companies emerging in the artificial intelligence infrastructure ecosystem, Nebius Group. Today's presentation is not simply about another cloud company or another AI stock. This is a discussion about infrastructure, the foundational layer powering the next decade of artificial intelligence. Over the last several years, the market has focused heavily on the visible layer of AI, applications like ChatGPT, Claude, Gemini, and enterprise copilots. But underneath every AI model exists an enormous physical infrastructure stack consisting of data centers, GPUs, networking systems, cooling systems, inference engines, and distributed compute architecture. That infrastructure layer is where Nebius operates. Nebius is attempting to become what the industry increasingly calls a Neocloud, a next-generation AI-native cloud provider built specifically for large-scale AI training and inference workloads. This presentation explores several critical questions. Why has AI infrastructure become one of the most capital-intensive opportunities in technology history? Why are hyperscalers like Microsoft and Meta outsourcing portions of AI compute? Can smaller specialized cloud operators compete against Amazon, Google, and Microsoft? And perhaps most importantly, does Nebius possess a sustainable moat, or is this simply a temporary AI cycle? Over the next 40 to 60 minutes, we will examine the transformation from Yandex to Nebius, their infrastructure strategy, financial growth and contract backlog, their relationship with NVIDIA, their sovereign AI positioning in Europe, competitive comparisons against CoreWeave and hyperscalers, and risks, valuation scenarios, and execution challenges. This is ultimately a presentation about scale, execution, engineering talent, and capital allocation. And as we will see throughout this deck, Nebius may represent one of the highest risk, highest reward infrastructure plays currently available in public markets. Before proceeding further, it is important to establish the appropriate context and limitations of this discussion. This presentation is intended strictly for educational and research purposes. Nothing discussed here should be interpreted as financial advice, investment advice, legal advice, or tax guidance. The AI infrastructure industry is evolving extremely rapidly. Revenue forecasts, valuation assumptions, GPU deployment schedules, and capital expenditure guidance can change materially within a single earnings cycle. Many of the projections discussed today are based on public SEC filings, company guidance, industry research, analyst consensus estimates, infrastructure deployment assumptions, and competitive positioning analysis. Forward-looking assumptions involve substantial uncertainty. AI infrastructure is also uniquely sensitive to geopolitical developments, export restrictions, GPU supply chain disruptions, energy availability, data center construction delays, regulatory intervention, and changes in enterprise AI spending. Investors should therefore approach all valuation frameworks with appropriate caution. This presentation is designed to stimulate analytical thinking rather than provide definitive investment recommendations. As always, conduct independent due diligence and consult qualified professionals before making investment decisions. To truly understand Nebius, we must begin with its origin story. Nebius did not emerge as a traditional Silicon Valley startup. Its roots trace back to Yandex, often described as the Google of Russia. For decades, Yandex developed world-class expertise in distributed computing, search optimization, data center engineering, AI research, networking infrastructure, autonomous systems, and large-scale software architecture. However, following the geopolitical disruptions associated with the Russia-Ukraine conflict in 2022, Yandex underwent one of the most complicated corporate restructurings in modern technology history. The company separated its Russian operations from its international assets. In July 2024, Yandex completed a $5.4 billion divestiture of Russian assets. What remained became Nebius Group, a Dutch-listed AI infrastructure company focused entirely on international operations. This restructuring created a highly unusual starting point. Unlike most infrastructure startups, Nebius began life with approximately 1,300 experienced engineers, existing data center assets, deep infrastructure IP, existing AI expertise, and billions of dollars in cash. That is extraordinarily rare. Most startups face two existential bottlenecks: lack of capital and lack of talent. Nebius began with both, and that dramatically altered their competitive trajectory. Importantly, the restructuring also repositioned Nebius strategically. Rather than competing as a regional internet company, Nebius repositioned itself as a global AI infrastructure platform, a sovereign European AI cloud, and a specialized alternative to hyperscalers. This transformation culminated in a NASDAQ relisting, a major capital raise, strategic NVIDIA participation, and rapid expansion into AI-focused infrastructure deployment. This historical background matters because Nebius is not a typical startup trying to build credibility. It inherited decades of engineering sophistication from a mature technology organization, and that inherited DNA may ultimately become one of its most valuable competitive advantages. Now, let us discuss the core business model. What exactly is a Neocloud? Traditional hyperscalers such as Amazon Web Services, Microsoft Azure, and Google Cloud Platform were designed primarily for general-purpose cloud computing. Their infrastructure supports web hosting, databases, enterprise software, storage, networking, analytics, and general compute workloads. AI workloads were added later. Nebius, by contrast, was designed specifically for AI-first infrastructure. That distinction is critical. AI training and inference workloads are fundamentally different from standard enterprise computing. They require extremely high GPU density, advanced networking fabrics, ultra-low latency communication, massive power availability, specialized cooling systems, and high-throughput storage architecture. Nebius focuses exclusively on optimizing for those requirements. Their model consists of several layers. First, GPU as a service. Customers rent high-end NVIDIA GPUs, including H100, H200, Blackwell, and future Vera Rubin systems. Second, AI Studio. This is Nebius inference and deployment platform. Instead of charging solely for raw GPU hours, Nebius increasingly wants to monetize inference efficiency through per-token pricing. Third, dedicated enterprise clusters. These are multi-billion-dollar, multi-year infrastructure deployments customized for hyperscaler-scale clients. Fourth, sovereign AI infrastructure. This is particularly important in Europe, where many governments and enterprises increasingly prefer local data residency, EU AI Act compliance, non-US cloud dependence, and neutral infrastructure providers. Nebius positions itself directly into that market gap. One of the most important strategic insights here is this: Nebius does not need to replace AWS. It only needs to become indispensable for a subset of AI workloads. If AI infrastructure demand remains fragmented and specialized, smaller optimized providers may coexist alongside hyperscalers. That is the core strategic assumption behind the entire company. The financial growth trajectory of Nebius has been extraordinary. In FY 2023, revenue was extremely small. By FY 2025, revenue had surged to approximately $530 million. That represents roughly 479% year-over-year growth. Quarterly revenue acceleration has also been dramatic. Q4 2025 revenue exceeded $227 million. Importantly, management is guiding toward $3 to $3.40 billion in FY 2026 revenue, with ARR targets between $7 billion and $9 billion. These are enormous numbers relative to current scale. However, investors must understand the underlying dynamics driving this growth. This is not a traditional SaaS company. Infrastructure businesses behave differently. Growth occurs in bursts. A single data center deployment can unlock hundreds of millions in annualized revenue. A single hyperscaler contract can change the entire financial profile of the business. This creates explosive top-line growth, large CapEx cycles, uneven quarterly recognition, and significant execution volatility. We also need to recognize an important operational shift. Nebius turned operating cash flow positive. That is meaningful because infrastructure businesses often burn capital aggressively before utilization ramps. Positive operating cash flow suggests customer demand is real, clusters are being monetized effectively, and infrastructure utilization is improving. Still, profitability remains complicated. Why? Because GPU infrastructure carries enormous depreciation expense. Even if EBITDA improves, GAAP profitability may remain pressured for years. This creates a major debate among investors. Should Nebius be valued like a software company, a cloud infrastructure provider, a utility, or a capital-intensive industrial platform? The answer to that question will ultimately determine valuation multiples. Now we arrive at one of the most important validation signals in the entire Nebius story, the company's strategic alignment with NVIDIA. This relationship is not merely symbolic. In the AI infrastructure economy, access to NVIDIA GPUs is effectively equivalent to access to oil pipelines during an energy boom. Today, AI leadership is constrained by one critical resource, compute. And compute, at scale, is dominated by NVIDIA. Nebius has positioned itself as one of NVIDIA's early and strategically aligned infrastructure partners. That matters enormously because in periods of GPU shortage, allocation itself becomes a competitive moat. Remember, most cloud providers cannot simply order unlimited H100s or Blackwell systems. NVIDIA selectively prioritizes customers based on technical capability, deployment readiness, networking sophistication, power availability, and long-term strategic relevance. Nebius checks many of those boxes. NVIDIA first participated in Nebius's NASDAQ relisting capital raise. Later, NVIDIA reportedly deepened that relationship through an approximately $2 billion strategic investment. That investment is important for three reasons. First, preferred GPU allocation. Nebius gains earlier and larger access to Hopper systems, Blackwell systems, and future Vera Rubin architecture. Second, engineering collaboration. Modern AI infrastructure performance is not simply about owning GPUs, it's about optimizing interconnect bandwidth, inference throughput, latency, cluster orchestration, and power efficiency. Nebius inherited deep distributed systems expertise from Yandex, and NVIDIA appears to view them as technically capable enough to deploy cutting-edge infrastructure at hyperscaler scale. Third, customer signaling. When enterprise clients see NVIDIA strategically supporting Nebius, it dramatically increases confidence, and that credibility likely played a major role in attracting hyperscaler-scale contracts from Meta and Microsoft. But we also need to recognize the structural dependency this creates. Nebius is deeply tied to NVIDIA's ecosystem. If future AI hardware architectures diversify away from NVIDIA dominance, perhaps through custom ASICs or internally designed accelerators, Nebius would face adaptation pressure. For now, however, the NVIDIA partnership remains one of Nebius's strongest strategic assets and arguably one of the biggest reasons the market takes the company seriously. This slide contains arguably the single most important figure in the entire investment thesis, the backlog. Nebius currently reports roughly $45 billion or more in contracted backlog. That number is extraordinary relative to a company with a market capitalization around the mid-$20 billion range. The backlog is primarily anchored by two giants, Microsoft and Meta. The Microsoft agreement alone is estimated around $17.4 billion over 5 years. Meta's agreements are even larger, with expanded commitments potentially exceeding $27 billion tied to future Vera Rubin deployments. These are not small experimental pilot projects. These are large-scale infrastructure commitments tied directly to the global AI arms race. And this fundamentally changes how investors analyze Nebius. Without backlog, Nebius would simply look like a speculative AI cloud startup. With backlog, the debate shifts from can they find customers to can they execute fast enough? That distinction is critical. Management has also indicated that available capacity is effectively sold out. That tells us something extremely important about current AI infrastructure demand. The bottleneck is no longer customer acquisition. It is supply expansion. Now, investors must still analyze backlog quality carefully. Backlog does not automatically equal guaranteed revenue realization. Large infrastructure contracts typically contain deployment milestones, performance conditions, grace periods, termination rights, and hardware delivery requirements. Meta's Vera Rubin agreements reportedly include deployment timelines that Nebius must meet to preserve the full contract value. That means execution risk is enormous. This company is now operating under hyperscaler scale expectations despite being dramatically smaller than AWS, Azure, or Google Cloud. The challenge is no longer proving technical capability in theory. The challenge is delivering infrastructure at industrial scale while maintaining reliability, uptime, and deployment speed. If Nebius succeeds, the backlog creates massive revenue visibility. If execution slips, the downside could also be substantial. This is why the market remains both excited and cautious simultaneously. AI infrastructure is ultimately a physical business. That point cannot be overstated. Investors often think about AI through software interfaces like ChatGPT or Claude. But underneath every AI interaction exists enormous physical infrastructure requiring land, transformers, cooling, networking, fiber, water systems, and most importantly, electricity. Nebius understands this deeply. Their infrastructure roadmap is centered around scaling connected power capacity. The company is moving from approximately 75 megawatts of initial infrastructure toward 1 gigawatt connected by 2026 and roughly 2.5 gigawatts contracted. Those numbers are enormous. Modern AI data centers increasingly resemble industrial energy projects rather than traditional server facilities. Nebius has strategically expanded across Finland, Kansas City, New Jersey, France, and Iceland. The Finnish positioning is particularly important. Why? Because Finland offers several structural advantages: hydroelectric power, nuclear energy, cooler climates, lower cooling costs, strong renewable credentials, and favorable ESG optics. Nebius also emphasizes waste heat recycling. Their Finnish data centers channel excess heat into district heating systems. That creates several advantages simultaneously: lower operational costs, environmental credibility, stronger regulatory alignment, and improved political acceptance. Importantly, power availability may become more important than GPU availability over time. Many investors still focus heavily on NVIDIA supply. But increasingly, the real bottleneck is electrical infrastructure. Whoever secures scalable, low-cost, reliable energy access may ultimately dominate AI infrastructure economics. Nebius appears to recognize this earlier than many competitors, and that energy-first strategy could eventually become one of their most underappreciated competitive moats. Nebius is not simply renting GPUs. The company also controls or maintains exposure to several AI-adjacent assets that strengthen the broader ecosystem narrative. These include Toloka AI, Triple 10, Avride, ClickHouse exposure, and sovereign AI projects like the Israeli National Supercomputer Initiative. Let's briefly examine why these matter. Toloka AI operates in data, labeling, and reinforcement learning feedback infrastructure. As generative AI models become increasingly sophisticated, demand for high-quality labeled datasets continues growing rapidly. That positions Toloka inside the broader AI development pipeline. Triple 10 operates in education and workforce reskilling. This is more indirect exposure, but still strategically relevant because AI adoption creates enormous labor transition demand globally. Avride is perhaps the most speculative but potentially highest upside subsidiary. It focuses on autonomous vehicles and robotics, what many now call physical AI. If robotics becomes the next major AI wave after generative models, Avride could eventually become independently valuable. Then we have ClickHouse, one of the most respected open-source analytics databases globally, used by companies such as Cloudflare, Uber, and ByteDance. Nebius retains equity exposure through historical Yandex investments. Potential future liquidity events here could unlock additional hidden value. Finally, sovereign AI infrastructure. The Israeli National Supercomputer Project demonstrates Nebius's ability to compete for government-backed AI infrastructure contracts. This is strategically important because sovereign AI spending is likely to increase globally over the next decade. Countries increasingly want domestic AI compute capability rather than total dependence on foreign hyperscalers. Nebius positions itself directly into that geopolitical trend. Now we examine the competitive battlefield. Nebius operates in one of the most competitive and capital-intensive sectors in modern technology. Its competitors include CoreWeave, AWS, Azure, Google Cloud, Lambda Labs, Crusoe, and several emerging sovereign AI providers. The most important comparison is CoreWeave. Why? Because both companies belong to the emerging Neocloud category, specialized AI-native infrastructure providers. However, their financial structures differ dramatically. CoreWeave financed aggressive expansion using debt secured against NVIDIA hardware. Nebius, by contrast, began with billions in cash, inherited infrastructure, and lower initial leverage. That distinction materially changes the risk profile. Nebius positions itself as more optimization-focused, more sovereign AI-aligned, less financially leveraged, and more engineering-driven. Compared to hyperscalers, Nebius offers specialization rather than breadth. AWS and Azure possess enormous balance sheets, global infrastructure, enterprise ecosystems, and unmatched scale. But hyperscalers are not always optimized specifically for AI-native workloads. Nebius argues that specialized tuning matters enormously. Even small efficiency improvements in inference or training workloads can produce huge economic savings at scale. For example, lower latency, better GPU utilization, optimized networking, or faster inference throughput can materially improve customer economics. That optimization layer is where Nebius claims differentiation. However, the competitive pressure remains intense. Hyperscalers possess almost unlimited financial resources. If AI infrastructure becomes commoditized, pricing pressure could become severe. Therefore, Nebius cannot simply be a GPU landlord. They must continually prove that optimization, sovereignty, flexibility, and engineering expertise create sustainable differentiation beyond raw hardware access. That is the core strategic battle facing the company over the next 5 years. Now we arrive at the most important section for serious investors: the risks. Every extraordinary growth story carries extraordinary execution risk, and Nebius is no exception. In fact, this company sits at the intersection of multiple high-risk variables simultaneously: hyperscaler dependence, infrastructure execution, financing pressure, geopolitical perception, and technology commoditization. The first and most obvious risk is customer concentration. Meta and Microsoft together represent the overwhelming majority of Nebius's contracted backlog. That creates enormous dependency. If either company reduces AI spending, delays deployments, changes architecture strategy, or internalizes infrastructure capacity, Nebius could face a dramatic revenue shock. And because the company is still scaling, there is limited diversification protection today. The second major risk is capital intensity. Management's projected CapEx requirement for 2026 is staggering, potentially $16 to $20 billion or more. That is hyperscaler scale infrastructure spending. Nebius therefore must continuously secure debt financing, asset-backed facilities, equity issuance, or strategic partnerships. Even if demand remains extremely strong, financing risk remains real. Third is execution risk. Building AI infrastructure at this scale is extraordinarily difficult. Projects can be delayed by transformer shortages, construction bottlenecks, power grid delays, GPU supply constraints, cooling integration issues, or networking failures. Meta's contracts reportedly contain delivery obligations and termination rights tied to deployment schedules. That means timing matters enormously. Fourth is commoditization risk. Nebius itself acknowledges this issue indirectly. If GPU infrastructure eventually becomes widely available through hyperscalers, pricing pressure could intensify rapidly. In that scenario, Nebius must prove that optimization, sovereign AI positioning, inference efficiency, and customization create durable differentiation. Otherwise, GPU rental risks becoming a commodity business. Fifth is geopolitical overhang. Although Nebius fully separated from Russian operations following the Yandex restructuring, perception risk still exists among some institutional investors. Even perception alone can suppress valuation multiples. Finally, dilution risk. Scaling AI infrastructure requires enormous capital. Nebius has already introduced convertible debt, ATM equity programs, and additional financing structures. As share count expands, investors must monitor whether growth meaningfully outpaces dilution. This is why Nebius represents both one of the most exciting opportunities in AI infrastructure and simultaneously one of the highest risk execution stories in public markets. The Nebius investment thesis ultimately rests on three foundational beliefs. And importantly, all three must hold simultaneously for the bull case to work. The first belief: AI demand is real and economically durable. Right now, hyperscaler spending strongly supports this assumption. Meta, Microsoft, OpenAI, Amazon, and Google are collectively spending tens of billions of dollars on AI infrastructure. That level of spending implies these companies believe AI will generate substantial future economic returns. Nebius benefits directly from that spending cycle. However, there's a counterargument. Some analysts believe future model efficiency improvements could reduce overall compute demand. If AI becomes dramatically cheaper to train and run, infrastructure economics could change materially. That is the first major debate. The second belief: the AI infrastructure market remains fragmented. Nebius benefits if enterprises continue demanding specialized infrastructure, sovereign AI compliance, customized deployments, and optimized workloads. If instead the market consolidates entirely around hyperscalers, smaller Neocloud providers could struggle. Nebius is effectively betting that local regulation, customization, latency optimization, and enterprise specialization will preserve space for independent infrastructure providers. The third belief: optimization creates sustainable differentiation. This is arguably the most important pillar. Nebius argues that infrastructure optimization matters enough to create a moat. Even small improvements in latency, GPU utilization, inference efficiency, or throughput can create enormous savings at scale. If Nebius consistently delivers better economics per token or per workload than hyperscalers, customers may remain loyal despite larger competitors. But if optimization advantages disappear, the business risks commoditization. In that scenario, scale likely wins. So the Nebius thesis is not merely about AI growth. It specifically requires sustained AI demand, continued market fragmentation, and optimization-driven differentiation. All three must remain true simultaneously. Now, let us examine the valuation framework and scenario analysis. Nebius is one of the hardest companies in the market to value today because outcomes vary enormously depending on execution success. This is not a mature software company with stable recurring cash flows. This is a hyper-growth infrastructure build-out story. The bear case assumes substantial execution problems. Under this scenario, deployment delays emerge, Meta or Microsoft reduce commitments, financing costs rise, or AI infrastructure demand weakens. Additionally, geopolitical concerns or commoditization pressure could compress valuation multiples. Under the bear case, price targets fall toward the $45 to $65 range. That would imply significant downside from current levels. The base case assumes management largely executes successfully. In this scenario, revenue guidance between $3 and $3.4 billion is achieved, Vera Rubin deployments remain on schedule, EBITDA improves, and infrastructure utilization scales efficiently. If those conditions hold, Nebius likely re-rates closer to infrastructure growth peers. Under this scenario, price targets expand toward the $120 to $160 range. Then comes the bull case. This is where the story becomes extremely powerful. The bull case assumes ARR approaches or exceeds $9 billion. Infrastructure deployments execute flawlessly. Enterprise diversification expands. Sovereign AI demand accelerates. And profitability improves materially. In this environment, Nebius could evolve from speculative infrastructure operator into a globally strategic AI platform. Potential upside scenarios then move toward $200, $250, or potentially beyond. However, investors must recognize something very important. This is a highly nonlinear valuation story. Small differences in execution assumptions produce enormous differences in valuation outcomes. That is why the stock experiences such high volatility. The market is constantly recalculating execution probability in real time, and that means quarterly updates become critically important. One of the most interesting aspects of Nebius today is relative valuation. At current pricing levels, Nebius trades at a notable discount to certain AI infrastructure peers on forward revenue multiples. The comparison investors focus on most heavily is CoreWeave. CoreWeave currently commands materially higher forward revenue multiples despite also operating in a highly capital-intensive AI infrastructure segment. Why does Nebius trade cheaper? The answer is simple. The market remains cautious about execution. Specifically, meta concentration, deployment timing, capex burden, and revenue skew toward late 2026. If Nebius successfully delivers infrastructure at scale while hitting guidance, many analysts believe the valuation discount could narrow substantially. The market today effectively prices Nebius as prove it first, and that skepticism is understandable. The company is attempting something extremely ambitious, building hyperscaler-grade infrastructure while still early in its public market lifecycle. The key insight here is that Nebius does not necessarily need hyperscaler-scale margins immediately. It needs execution credibility, revenue realization, and operational consistency. If those emerge, multiple expansion becomes possible. But if deployment timelines slip or financing pressure intensifies, valuation compression could continue. This is why investors increasingly monitor quarterly deployment updates, power connectivity, GPU delivery schedules, and utilization rates almost more closely than traditional income statement metrics. Infrastructure businesses are ultimately judged on execution reality rather than narrative. For investors following Nebius, several metrics deserve extremely close monitoring over the next 12 to 24 months. The first is ARR progression. Management guidance toward $7 to $9 billion ARR is extraordinarily ambitious relative to current scale. Investors need evidence each quarter that deployment schedules support that trajectory. Second, gross margins. Margins provide insight into infrastructure efficiency, pricing power, GPU utilization, and competitive intensity. If margins remain strong while scaling rapidly, that would reinforce the optimization thesis. Third, deployment timelines. The Vera Rubin rollout schedule is absolutely critical. Any delays could materially impact revenue realization and investor confidence. Fourth, customer diversification. The market wants evidence that Nebius can expand beyond Meta and Microsoft. Additional enterprise or sovereign AI contracts would materially strengthen the investment thesis. Fifth, financing discipline. Investors should carefully monitor debt issuance, equity dilution, asset-backed financing, and cash burn rates. Infrastructure companies can grow revenue aggressively while still destroying shareholder value through poor capital allocation. Sixth, NVIDIA relationship stability. Preferred allocation remains strategically important. Any change in that relationship would likely affect market perception significantly. Seventh, sovereign AI trends. Government spending on domestic AI infrastructure may become a major long-term demand driver globally. Nebius is well-positioned if that theme accelerates. Finally, near-term catalysts. The most important catalyst remains quarterly earnings and deployment updates, because this is ultimately an execution story. Every earnings release acts as a real-time referendum on whether management is successfully delivering industrial-scale AI infrastructure. As we move toward the conclusion, Let us summarize why Nebius has attracted so much attention in global AI infrastructure markets. The company possesses a very unusual combination of advantages. First, inherited engineering DNA. Nebius did not start from zero. It inherited elite distributed systems expertise, infrastructure engineering talent, AI optimization experience, and data center operational knowledge from Yandex. Second, strategic positioning. Nebius sits directly at the intersection of AI infrastructure growth, sovereign AI demand, and hyperscaler compute shortages. Third, NVIDIA alignment. Preferred GPU access remains one of the most valuable assets in the AI economy today. Fourth, backlog visibility. The company already possesses hyperscaler-scale customer validation through Meta and Microsoft. Fifth, sovereign AI relevance. As governments increasingly prioritize domestic AI capability, Nebius's European positioning may become strategically valuable. But investors must also balance these strengths against significant risks. Customer concentration, CapEx intensity, financing needs, execution pressure, and dilution. This is therefore not a low-risk investment. It is a high-risk, high-reward infrastructure scaling story. The market is essentially asking one question. Can Nebius successfully transition from promising Neocloud provider into a globally relevant AI infrastructure platform? The answer to that question will likely determine the company's long-term valuation trajectory. To conclude, Nebius represents one of the most fascinating infrastructure stories emerging in the AI era. The company now operates at the intersection of several massive global trends: artificial intelligence, sovereign computing, GPU acceleration, energy infrastructure, and distributed cloud architecture. Its transformation from Yandex assets into a global AI infrastructure platform is extraordinary. But the next phase will be much more difficult than the first. Building AI infrastructure at hyperscaler scale requires engineering excellence, capital discipline, operational precision, energy access, and sustained customer trust. Nebius now has the opportunity to prove whether specialized AI-native cloud providers can coexist alongside trillion-dollar hyperscalers. That is the central strategic question. Will optimization and specialization matter enough to preserve independent Neocloud platforms? Or will scale ultimately dominate the market? The answer will not only shape Nebius's future, it may shape the broader structure of the AI infrastructure economy itself. Thank you everyone for your attention. I look forward to the discussion and your questions. Do your own research. Consult a qualified financial professional before making any investment decisions.